Welcome to the video. From thumbnail, I think you already know what we are discussing today. As we all know, recently the finance minister increased the STT on futures and on the options. So the increase is actually pretty high, and that is going to impact the traders a lot. So to see the numbers exactly, so the STT on futures was increased to 0.02% to 0.05%, and the STT on options was increased to 0.15%. And this change is effective from April 1st. So uh, we should understand exactly, we should have a clear image on how exactly this STT is going to affect the traders. So let's say as a trader is making 100 trades and is winning on 80 trades and is losing on 20 trades. So on the 80 trades that he is winning, he is, let's say for example, he is making 3 rupees. On the trades that he is losing, that is 20 trades, he is losing 2 rupees. So basically, he has now 80 and he's losing 2 rupees. Sorry, he has like 80 into 3, that is 240, and then he is losing 20 into 240. So he is making 200. So let's say this STT is now currently it's increased 2.5 times. For this example, I'll assume okay, the increase in charges now it is 1 rupee. So in that sense, in the 80 trades that he is winning, he's actually only making 2 rupees, and the 20 trades that he is losing is actually losing 4 rupees. So how exactly this will look like now? Let's say 80 that is into 2, it's 160, and the 20 into 4, 80. So 160 minus 80 is 80. So just see the difference. So earlier he was making 200 rupees net profit, and now it just came down to 80 rupees. That's the impact of charges and taxes that we are paying. So okay, it is increased and it is getting effective from April 1st. Is there any way out? Definitely there is a way out. We can do some change in the way we are trading, changes in the instrument that we are choosing, and effectively can do the same but pay the less charges. So the concept is synthetic futures. So how exactly it is, like it is a payoff that is similar or same to the future payoff, but that is obtained by combining different options. As you can see on the slide, I have given payoff of different options also. So basically, of any given strike, preferably the ATM, if you buy a call and then if you sell a put, you can see the payoff of the call and you can see the payoff of the put. If you combine these two, this will be same as a future payoff. Well, this is an example for a long future. Similarly, you can do it for a short future. So the payoff is just the same. And if you ask me what about delta, the exposure, margin, effectively it is all around the same. It will be very much same. So this is how the like payoff will look like, and the concept of this comes from a formula called put call parity. Like the formula is there on the slide, but to give an example, so let's say for the same strike, the call price is 100 and the put price is 50 rupees. So in that sense, let's say I want a future long. So I'm buying call and I'm selling put. I'm buying 100 rupees and I'm receiving 50. So then it is 50 rupees. So and the strike that I'm using here is, let's say, 500. 500 is the strike. So this 500 plus the net amount 50. So 500 plus 50, 550 is my average like buy price of this future. So this future buy price that which I computed from this option call and put prices, this price should equate to the actual futures price that is being traded. That's what this formula is actually like showing. You can check all these things in live market. So as I told, so basically you have to buy the call, preferably the ATM, and sell the put of the same particular strike. Yes. There's a bonus tip also. Okay, this is for a short actually. Let's say for the buy call and sell put, if you go OTM and buy the put, so basically the risk will be limited and the margin comes down drastically. Even in this example, this is a short futures. So I'm selling the call and buying the put. So that is a naked short future. And what I'm doing here is I'm just going and buying OTM call. So this is the edge. So you can see that this caps my maximum loss. And also this is also going to decrease the margin drastically. This is the bonus tip. for your reference. Okay, so I explained about synthetic futures. I know STT is increasing the future. Like the direct question would be how exactly is this synthetic futures is going to help us. So to understand that, the STT, which is actually in the percentage terms. So this on the futures, if you calculate the charges, it is actually on the notional. Let's say the future price is 25,000 and the lot size is 65 and the charges of STT is 0.05%. That will equate to 25,000 into 65 into 0.05%. But when it comes to option, is it not on the underlyings like a notional calculated using the underlying, but rather it is a notional calculated using the option premium. So of any option that I'm trading, let's say the premium is 30 rupees, the notional would be 30 into lot size. That's it. And then the charges is 0.15%. So this will be like I think almost 40x. So in that range, it is cheaper than the STT on the futures, actual futures. You can see pictorially, I have tried to put that in the presentation. This is how it actually looks like. I've taken a live example also. So based on that no current notional of Nifty futures, the if you just buy and if you just sell, and that just the STT will come around 812 rupees. But let's say on expiry day, if you do the same thing on ATM options, that is it is just 20 rupees. Just see the difference. It's almost 97% tax drag. If you ask me, are there no drawbacks from doing this synthetic futures? There are definitely there. So STT is going down, that's definitely yes. But since you are adding multiple positions like buy, call, sell, put, and if you want to hedge, like you are doing some all these three legs. So this is going to increase the brokerage. It is minimal, but still it is going to increase the brokerage and the bid-ask spread. So, like if you know the bid-ask spread, it is little tighter in the indices. So, let's say on the future it was a mix, doing three legs. The risk of bid-ask spread is almost now slightly higher because of three legs. That's fine for now because this is for the indices, and also the slippage on enter and exit. Like in the future, we had a risk of only one leg slippage. Here we could have three leg slippage. If all three is not executed at once, there could be a problem. And important thing. So I have specifically given example of indexes and also explained with terms that is related to indices. But by any chance, if you are trying to do this on equity futures, if equity FNO, you have to be very much cautious because one thing is index FNO is equity like cash settled, whereas the equity FNO is not cash settled. Like if you do some long future on Reliance, so basically you will get the delivery, you will get that amount of like Reliance share to a demat account. You should have that capital ready, and that again attracts different kind of charges. That is a bigger headache. So if you are by any chance doing equity FNO, this has to be the positions has to be closed before the expiry week, and also like the broker may automatically score off your positions on the expiry week because the margin is 100%. And if you don't have the margin, you will just square it off at whatever the loss or profit that you are currently at. To avoid that, you better plan accordingly and square it off. This is one specific that I need to put out. Margin, though, I've already told that the margin on the future and synthetic future will be very similar. It will be nearby. The skew. So you know, right? The payoff graph that I showed, which I told you that it is similar to the future. It is given that the call IV and the put IV is the same. It is going to be like fixed and it is not changing. Is the assumption there? If you don't know what exactly is IV, IV actually is an implied volatility. To understand what IV is in simple terms, let's say the option premium is five rupees. Like we have a Greeks on that. We know what is the time value, what is the intrinsic value, all these things. Let's say suddenly the demand for that particular option increases and like people are buying, it went to 6 and 7. It is increasing. So this change, this additional change, which is not accounting anything, actually is used to compute the IV to calculate the implied volatility. So if there is uneven differences or uneven movement in this call IV input IV, the payoff, the synthetic payoff which I showed earlier, that there could be slight deviation. This is a very negligible thing, but still I am putting that into notice in this particular part. It is good to know. So finally, let's come to the checklist. So we understand that we are using option, like synthetic futures, using the options, and we are going to save some charges. But we should not forget the risk that is coming from this. The first thing is whatever the instruments that you are trading, make sure the liquidity is good. Always use basket orders and execute all the legs at once. Stick to indices. Don't go to stock FNO if you are not used to it or if you don't have experience in it. This one thing, the last thing which I've heard many people doing this mistake. So, if whenever you go to take an order, you know that you see MIS, intraday type, and you see NRML, which is for the uh, longer duration. So especially while doing synthetic futures, like you are doing multiple legs, right? So you have to make sure that you are doing all the three legs in the same order type. By any chance you do two legs at with intraday type MIS and another one leg you do at as a norm NRML, holding it for a longer time. So apparently the MIS orders get squared off at the end of the day, and you will have a open I don't know, whatever the leg that is open, so you will have a position that is not intended, that could lead to some potential risk. So make sure that you don't do this mistake. Finally, the summary. We understood the change in STT and its impact on the traders, especially the taxes and charges. And also we understood what is synthetic futures, so how exactly to create a synthetic futures with options. We also understood the charges, the differences, how the STT is calculated on the futures and the options, and how exactly we are using this difference to create a synthetic future and reduce our charges and taxes. And also, we also understood the consequences of doing this synthetic future and the steps that we have to take in order to avoid risk. So this was all about this video. Hope if by any chance if you are a future trader paying 800 rupees, 900 rupees per lot, I hope this video helps and you can save some charges and taxes. I hope you like this video. You can give a like if you like this, and also if you have any question, please put it in the comment. And if this video gets 100 likes, I'm very happy to uh, do an execution plan of taking any specific stock or index, show this in the basket order, and maybe explain how to do everything and execute it. Thank you very much for watching.